extending the amounts on a worksheet. So on this one, it says the adjusted trial balance for Planeta Company follows. Complete the worksheet by extending the account balances into the appropriate financial statement columns by entering the amount of net income So we see here that there's some of these things that aren't going to affect income, but then we see that there's things that, and then we see that there's things that go on the balance sheet. So for example, cash, we know that we would go ahead and place cash in the debit column for the balance sheet because cash is an asset, so normally would have a debit balance, so we can just extend that over. We see likewise that accounts receivable is an asset, and so an asset's recorded on the balance sheet and normally have a debit balance, so we can do that. Trucks, same thing, that's an asset, so we can just go ahead and bring that over as a debit on the balance sheet. The accumulated depreciation of trucks is 17.5. Again, that affects the asset, and so, but it's decreasing the asset. Because it's decreasing the asset, it would be a credit on the balance sheet. And then land would be a debit on the balance sheet because it's an asset. And then accounts payable is a liability, so in order to do that, it would be a credit. Salaries payable also is a liability, so it affects the balance sheet. Same thing with unearned fees. It is a liability, so it's a credit, and again, it affects the balance sheet. And then F, Planeta Capital, is a credit, and that affects the, or is a credit because that affects the balance sheet and it's part of equity. And then withdrawals is part of equity, but it's reducing the capital, and so we would place that on the balance sheet. So now finally, we're now on to the part where we are for the income statement. So plumbing fees earned is a credit, and that goes on the income statement. Depreciation expense trucks, that's an expense. So because this is plumbing fees earned, that's revenue, so we would credit for the income statement, but all of our expenses would be debits. So the truck expense, that depreciation, that would be a debit. Salaries expense, that is a debit. Rent expense is a debit. And then miscellaneous. So now what we have to do now, is we have to add these up in order to figure out what our net income is. So if we take all of the expenses plus 3,800, or 38,000, excuse me. So we have expenses in the amount of 66,200. And then we have income in the amount of 84,000. So now if we subtract, so if we take our income, our revenue, and then minus the expenses, that gets us our net income, which in this case is 17,800. And so that would be a debit on the income statement, and then that would also be, and then that would be a credit, and then that would be a credit on the because that affects the equity, increases equity. Okay. And again, you can see too that we added these up, so 123,600 and then 105,800 plus the income, the net income, then that comes out to 123,600. So then we see here that our income statement balances, and we see here that our balance sheet and statement of owner's equity, we see that that balances. Okay.
Oh, I was curious as to how to determine if we put it in the income side or the balance side. Like, you know how you got towards the bottom? Like, how do we decide if it's on income or on balance sheet statement?
Okay, it just has to do with the type of account it is. So, for example, you have assets, liabilities, and equities. Those are all balance sheet accounts.
Okay.
So for example, cash, accounts receivable, the trucks, also the depreciation for the trucks, land, those are all assets. We see here that these right here, I'll just do an A. So these are all assets. Then we see here accounts payable, salaries payable, unearned fees. What would those be?
Oh, I'm muted, right? A liability?
Liability. Yeah, no, you're not muted. So those are liabilities. So where would liabilities and assets go?
Those go in your balance sheet.
That's correct. And then we see here that F, Planeta capital and withdrawals, that's part of equity, and equity also goes on the balance sheet.
Okay.
And then we know here that this other here is the revenue, is the plumbing fees earned. So that's the revenue. So that's, again, you could have multiple sources. So for example, maybe they have a plumbing business, but maybe they rent out maybe part of their shop for something else. Then they also would have rental income. So that would be separate. But for right now, they just have the one. So that's income statement because that's revenue. Just do an R here. But it's income. And then these are all of the expenses for their business, the rest of these, the expenses. And so then, and let me see if I can get a different color or a highlighter. Let's do that maybe. So all of these, and I'll just kind of highlight a yellow box here. So all of these would be part of income. What's in the box that I'm highlighting in yellow? Okay. So it's just, you just have to just know what you're talking about in terms of if it is an asset, a liability, an equity, or if it's part of the income statement. So no, thank you for asking, because that's a very valid question. Doing the adjusting entries on the worksheet. So we see here it says, use the following information from the adjustments column on a 10-column worksheet to prepare the necessary journal entries. So they're not showing us the entire worksheet, they're just showing us the part that we need. And so they already have the adjustments here listed. Okay. And so now what we have to do now is to create the journal entries. So the first one is A, which is the insurance expense. And so you would debit insurance expense for 900, and then you would credit prepaid insurance for 900. We've already done this, I believe, before. But this is just review, for us. And so that's for the expired insurance. The next one is office supplies. So we see here that you have office supplies expense, $17.50 debit, credit to office supplies, and that's to record the consumed supplies. And then you have C, which is the depreciation expense on the office equipment. You would debit that, $2,200, and then you would credit the accumulated depreciation of office equipment. And you have interest receivable, $800 debit, and then a credit to interest revenue, $880, and that is to record the interest income. So maybe they have a savings account, or they have something else that they're receiving interest income from. And then they have office salaries expense, $560, salaries payable, $560, and that's to record the accrued salaries. And so they're payable because they haven't paid them yet. They will, but they haven't paid them yet. So now we're going to talk about closing entries now. These income statement columns from a 10-column worksheet are for Brown's Bike Rental Company. And so the first thing that we need to do is we need to determine the amount that should be entered on the net income line of the worksheet. And then we'll prepare the company's closing entries. The owner, H. Brown, did not make any withdrawals during this period. Is just go ahead and add them up. Because they already figured out then that this was for the, let's go down here real quick. Let me get the pointer. Okay. So we see here that rents earned, that would go up here. That's part of revenue. And then we see here the various expenses that they had. So they had salaries, expense, insurance, etc. So they had a total of $94,400 in expenses, total revenue of $120,000. So they had net income, or another way of saying would be profit, of $25,600. And so you just bring those down. So then our closing entries then is we have to close out the revenues. And so they had rent earned of $120,000, and then they had so you would debit the rent earned $120,000, because you see right here it's a credit. So in order to reverse it, to clear it out, to close it out, you're going to do the opposite. So we debit, and then we'll credit to income summary $120,000. And so that closes the revenue. So this company, they rent out bicycles, I guess, to people. Okay. So then the next thing we have to do is to close all of the expenses. So notice that now these are debits. And so when we go to do it, we would do the opposite. So the first thing is you can set up is you have income summary would be a debit. We don't know the total yet, so we'll wait. And then we just list the other expenses would all be credits. Because again, you're doing the opposite of what they did to close it out. So you have salaries expense, $46,300, insurance expense, $7,400, office supplies expense of $16,000, bike repair expenses of $4,200, and the depreciation expense on the bikes of $20,500. So you take the total of all of those, comes out to $94,400, and so you debit that, credit all of those. And then we have to close the income summary account now. Remember, I talked on the lecture, I talked about the income summary account as a garbage bag account, right? So we put everything in there. So we list, the rent earned and our expenses. We just do the opposite of what, we had done previous. Now, which is what I have to do tonight, is I have to take out the trash, right? So that's basically what we're doing here. So we have the income summary, which would be for $25,600 because that was the net income. So you would go ahead and debit that because that's what would have been left in there, because you take this amount as a debit and then, or as a credit, this amount as a debit, that's what would be left in there. And then you just go ahead and transfer that amount then to H. Brown Capital. So we'll debit income summary $25,600. We'll go ahead then and credit H. Brown Capital $25,600. So the following unadjusted trial balance contains the accounts and balances of Dillon Delivery Company as of December 31st. S. Dillon Capital was $307,000 on December 31st of the prior year. So use the following information about the company's adjustments to complete the 10-column worksheet. So unrecorded depreciation on the trucks at the end of the year was $40,000. The total amount of accrued interest expense at year end was $6,000. The cost of unused office supplies still available at the end of the year was $2,000. And then prepare the year-end closing entries for this company and determine the capital amount to be reported on its year-end balance sheet. Okay, so then what we'll do, the first one they told us about was the depreciation for the trucks. So we'll debit, it would be a debit adjustment on the trucks for $40,000 for the accumulated depreciation, and then credit the accumulated depreciation. So we'll debit depreciation expense, trucks for $40,000, and then we'll credit the accumulated depreciation on trucks. And then the interest expense, so you have interest payable then would be $6,000 because that's the amount that they had. So the adjustment then would be a credit for $1,000 because we're increasing that. And then, yeah, so it would be a debit for interest expense, a credit for interest payable. And then you have for office supplies is $3,000. That shows what we used. So we're left with $2,000. So then you have office supplies expense, $3,000 debit, credit to office supplies. And so that's what's left. So we can go ahead and add up. And again, we know that those both balance out. So we know that we're correct there. So then what we can do is just go ahead and carry the other ones over. So cash, we'll just go ahead and carry that over as a debit. Accounts receivable, we'll carry that over as a debit. Office supplies is what we already adjusted. The amount for the trucks, we'll go ahead and bring that over. And we'll go ahead, since we added, since a credit and a credit, we'll add, still a credit. So 120,000, that's the accumulated depreciation on the trucks. And we'll just go ahead and carry over the land, the debit. Accounts payable, that amount's not going to change. The interest payable, that's going to increase, so we'll go ahead and do that. Notes payable hasn't changed, we'll just carry that over. And then the capital will carry over, and then withdrawals will carry over. The delivery fees earned will carry over. The depreciation expense on the truck, we added to it. And then the salaries expense, and then we can go ahead, the office supplies expense, the interest expense, and the repairs expense on the trucks. We'll just go ahead and either add to them or carry them over. So we get the total. Same thing, it equals out. And then we have to figure out what is it? Is it balance sheet or is it income statement? So we see here that cash goes on the balance sheet because it's an asset. So debit 16,000. Accounts receivable, same thing as an asset, goes on the balance sheet. So 34,000. Office supplies 2,000. Trucks 350. And then the accumulated depreciation 120, because that would reduce to tell you how much the trucks are worth now. The land 160,000. Then we have our liabilities, so 24,000 of accounts payable, 6,000 of interest payable, 100,000 of long-term notes payable, 307 is part of equity, that's the capital, and then 34,000 is the withdrawals. And then we have the income statement, 263,000, that is revenue, so credit, and then we list out the expenses. So 80,000 for the depreciation expense on trucks, 110,000 for salaries expense, 18,000 for office supply expense, 6,000 for interest expense, and then 10,000 for repairs expense on trucks. And so then we just go ahead and carry down 263,000 for the total. We go ahead and add up all of our expenses. That comes out to 224,000. But we have to add, and then 39,000 is the difference between this and this, or this and this. So that's how much our net income was. So then that equals 263,000, 263,000. And then we add that over here because that goes into the capital for the statement of owner's equity. So then that equals 596,000, 596,000. And then we need to record our closing entries. So because initially it was a credit, we'll go ahead and debit it. So the delivery fees earned $263,000, and then we'll go ahead and credit then into our income summary account $263,000, and then we go ahead and we will debit income summary, and then we'll go ahead and list out all of our expenses. Then you put the total. So the total debit for income summary then is $224,000, and then you list out all of the expenses. And then you have the income summary account for $39,000 debit, and then credit to S. Dillon Capital, because that's what would be left in there is $39,000, but that would be our net income, and then we need to increase that then for his capital. And then for the withdrawals is S. Dillon Capital $34,000, and then S. Dillon withdrawals $34,000, because we want to close out the withdrawals, and so before that was a debit, so we have to credit that, and then we also will debit the S. Dillon Capital because we need to reduce the capital by how much he took out. And so we see here that at the beginning balance for S. Dillon Capital was $307,000. Add the net income of $39,000, so that gives a balance of $346,000. So we have to less the withdrawals of $34,000. So that leaves then what would be in S. Dillon Capital. Ending balance would be $312,000. Again, preparing and posting closing entries. Use the May 31st fiscal year information from the following ledger accounts. Assume that all accounts have normal balances to prepare the closing journal entries, and then post those entries to the ledger accounts. So we have capital. So we will close the revenues to the income summary. So revenues. And then you have to close the expenses to the income summary. And then close the income summary to capital. And then close the withdrawals to capital. Okay, so that's the process that we've been following. The first one then, following that process. And again, it's important that you do it in that order just so that you don't get confused yourself about what's going on, okay? So the first thing is to close revenue. So we have service revenue, $76,000. And then we have the income summary of $76,000. So you'll debit service revenue $76,000 because normally that has a credit balance, so that would end up clearing this account, and then you will credit the income summary account. So now we see that that account now has a zero balance. So now we have to go ahead and close our expenses. So we'll just go ahead and list them. Depreciation expense $15,000. Salaries expense $20,000, insurance expense $40,000. We have our revenues, and we have our expenses. Okay, so if we did this, okay, so then that gives us then how much our net income is. So our revenue minus our expenses is $28,200. Okay, so that's the next thing that we have to go ahead and close out. So our net income then is $28,200. So then we're going to go ahead and close out the income summary to capital. So we have income summary. What's left in there is $28,200. And then M. Munsell Capital then is a credit for $28,200. 200 because we have to carry the net income then from the income summary then into her capital. So then that makes now the income summary now 0. We've now taken out the trash. We're done with that account for now. Okay. So the next thing is to close the withdrawals to capital, how much she took out. So we know that she took out $22,000. Again, you're going to do the opposite. So normally a Munsell withdrawals normally has a debit balance. So we're going to credit it in order to reverse it, in order to close it out completely. And then we have Munsell capital 22,000 because debit, and again we're going to debit it because we want to add to it. Or actually, excuse me, we have to debit Munsell capital because we have to reduce the amount of capital that she has now. We've already added 3. Let me write. So this amount right here, this is the net income, and I'll just do NI. Or actually, maybe I don't have to do this. I can annotate up here. It'll be easier. Okay. So this amount right here is the withdrawals. So again, it's going to reduce how much she had. So then that closes out the withdrawals account. And then that's going to give then what her new capital is. So this and this, subtract this, gets us 46,200. So equity accounts before closing. So we have debits of 69,800, credits of 116,000. So net credit of 46,200. All right, so the following adjusted trial balance contains the accounts and year-end balances for Cruise Company. As of December 31st, prepare the December 31st closing entries for Cruise Company. Assume the account numbers for income summary is 901. And then we'll prepare the December 31st post-closing trial balance for Cruise Company. So again, the first thing we have to do is to close the revenue. So we have service revenue of 44,000, and then we'll credit income summary for 44,000. And again, you're going to debit service revenue because normally it is a credit balance, but again, you're going to do just the opposite in order to close it out and clear it out. And then you want to close out our expenses. So again, we just go ahead and list expenses. So we have depreciation expense on the equipment of 3,000, salaries expense of 22,000, insurance expense of 2,500, rent expense of 3,400, and then supplies expense of 2,200. So again, we're just doing the opposite. So they normally have debit balances. In this case, we're going to credit them because we want to close them out, make them 0. So then you have income summary, then 33,100, because that's the total of all of those. And then we're going to go ahead and close out the income summary account. So the difference between this and this is 10,900. So we will debit the income summary 10,900, and then we'll go ahead and credit A Cruise Capital 10,900 because we need to add the net income to the capital account. Then we'll go ahead and close out the withdrawals account. So A Cruise withdrew $7,000 during the period. And so you have A Cruise Capital, 7,000. We have to debit from the capital in order to reduce it. And then you'll credit the withdrawals in order to go ahead and make that 0 to start fresh then for the new period. And so again, you see here, so you see here again the entries. PR is the account number, and then you see here again the debits and the credits. So you have A Cruise Capital December 31st for the prior year was 47,600. Then we have the net income of 10,900, and then you have $7,000, which was what was withdrew from the account. So then you have a balance then of 51,500. And then this is so post-closing trial balance. So this up here at the top, this was before you closed, and then at the bottom is the post-closing. So then all of your assets, those are going to remain the same. And then you have the accumulated depreciation of equipment, that's going to remain the same. But then accrues capital, you're going to carry that over from what you did before. And so 59,000, 59,000, so they both balance. Adjusted trial balance for Salon Marketing Company follows. Complete the four rightmost columns of the table by entering information of the four closing entries, keyed 1 through 4, in the middle columns, and completing the post-closing trial balance. So we have marketing expenses of 80,000, and so we, again, in order to close it, because it was a credit, we will go ahead and debit that. So we'll debit that and then credit income summary, and then we have so that's revenue, and then we have the expenses. So normally we debit, so in this case we'll credit. So we have 12,000 in expenses, and so then for income summary then would be a debit. So these are our expenses and our revenues. And then we'll go ahead and add the net income then, which is 13,800. So that would be a debit here for the income summary, but we'll go ahead and then credit to the eSalon capital. And then the withdrawals, we will credit the withdrawals in order to go ahead and clear that out, and then debit capital. And we can go ahead and add up both of those, and then we have the post-closing. Okay. Moving right along. So now we'll go ahead and do our financial statements. Use the following adjusted year-end trial balances at December 30 of Wilson Trucking Company to prepare the 1 income statement and 2 statement of owner's equity for the year ended December 31. The K. Wilson capital account balance was $175,000 on December 31 of the prior year. So the first thing we can do is our income statement. So we have trucking fees earned, $130,000. And we can list out which is credit, then we list out all of our expenses. So we have depreciation expense on the trucks, $23,500. Salaries expense, $61,000. Office supplies expense, $8,000. Repairs expense, truck, $12,000. So then our total expenses are $104,500. So we have net income of $25,500. Then we can figure out then the owner's equity. So we have K. Wilson capital December 31 of the prior year, $175,000. So then we can add the net income, which is $25,500. So that leaves then $200,500, less withdrawals by owner of $20,000. So K. Wilson capital December 31 of the current year is $180,500. Okay, so still looking at the Wilson Trucking Company, we'll go ahead now and prepare their classified balance sheet. So you have the assets, and then on the left-hand side, assets, liabilities, and equity on the right-hand side. So we have assets, you have current assets, and you have what are called plant assets, and then liabilities. Current liabilities and long-term liabilities. So cash is a current asset, accounts receivable is a current asset, office supplies is a current asset. So total current assets of $28,500. Plant assets would be trucks of $172,000, and then the accumulated depreciation of $36,000. Okay. So then that leaves then that the trucks are worth $136,000, and then land is $86,000. So total plant assets of $221,000. So again, current assets, we expect that those would be able to be used within a year, or they'd be able to be converted to cash within a year. And then we list plant assets. Those are things that we're going to use for more than a year. And then on their trucks, we can always resell a semi-truck. That's not a problem. But then land, obviously, that would be a little bit more difficult. That's why we list trucks first and then the land. And so you get that. So total assets then of $249,500. Then we can list our current liabilities, accounts payable of $12,000, interest payable of $4,000, total current liabilities of $16,000. Then we have a long-term note payable of $52,000. So then total liabilities of $69,000. So current liabilities, we expect that those would be paid off within a year. Long-term liability, the long-term note, obviously that note is for more than a year. And then we have owner equity, which is K. Wilson Capital, of $180,500, because that was what we figured out from before. What we're doing now is we're learning how to do our ratios. Because this is, I know there's some problems on the homework for this. So the current ratio is the current assets divided by the current liabilities. All right. So in our example, we see that current assets are cash, accounts receivable, and office supplies, and our current liabilities are accounts payable and interest payable. So 8,000 plus 17,500 plus 3,000, and then we have 12,000 plus 4,000. So that would be our current assets are 28,500 divided by our current liabilities of 16,000. So that means that our current ratio is 1.78. Following are Nintendo's revenue and expense accounts for a recent calendar year. Now, they kind of throw us a wrinkle, and it's because now, rather than us dealing in US dollars, we're going to be dealing with yen, because Nintendo, they're a Japanese company. But again, it's going to be exactly the same way as we did. So we'll go ahead and prepare the company's closing entries for its revenue and expenses. So we have net sales of $504,459. And then we'll go ahead and credit the income summary. Because again, normally sales is a credit, but we want to go ahead and clear it out. So we will debit. That closes out our revenues. Then we need to close out our expenses. So we know that we'll debit income summary. We don't know yet, but we have the cost of sales of $283,494, and then we have advertising expense $46,636, and then we have other expenses net of $157,881. You take the total of that. They had would be then a debit to net income of $487,941. So even if you're dealing with different types of currency, you're going to do the exact same thing. Figuring out the current ratio, we're going to calculate the current ratio in each of the following companies. We'll round the ratio to 2 decimal places. Identify the company that has the strongest liquidity position. These companies are all competitors in the same industry. Let's look at Edison. So they had current assets of 70,040. Divide that by 32,000. So they had a current ratio of 2.47%. Let's look at the next one here. MAXT. So they have 1.38% current ratio, or current ratio of 1.38, I should say. Let's look at Chatter. So they have a current ratio of 0.92. And then True. So again, and they already are giving us the current and the total for the current assets and the current liabilities. So we're skipping a step here that we don't have to figure that out. So 1.05. And then Gleason is 0.61. And so let me ask you a question. Which one of these has the strongest liquidity position, do you think? And you can unmute yourself to shout out, or you can type in the chat. What one do you think has the better liquidity position, more liquid?
Edison,
You're absolutely correct. Why is that?
because they have a larger ratio.
That's
Which
right.
means they have more revenue. I don't know.
Well, we're not revenue. This is assets. So they have more assets. So this
Income?
has to do with their ability to pay their bills.
Okay.
So the current liabilities are the bills that they have. So if you have more assets, you're in a stronger position, and that you're not as likely to default on your bills. Right?
Okay.
So yeah, I know we haven't really talked about this yet, but I just wanted you to see that. So the next one here are the reversing entries. And the book talked about that. I don't believe I assigned any of this for homework, but I might have. I can't remember, but I don't think I did. So let's look at this one. Hot Company records prepaid assets and unearned revenues in balance sheet accounts. So they do something a little bit different than what we've been discussing already, okay? So the following information was used to prepare adjusting entries for the company as of August 31st, which is the end of their fiscal period. So we see that the company had earned $6,000 in sales revenue that had not yet been recorded at period end. The expired portion of prepaid insurance is $3,700. The company had earned $2,900 of its unearned service fee account balance. Depreciation expense of office equipment was $3,300, and employees had earned but not yet been paid salaries of $3,400. So we'll prepare any necessary reversing entries in the accounting adjustments A through E, assuming that the company uses reversing entries in its accounting system. So you would then have to debit the accounts receivable, $6,000, and then credit the fees earned, because that, oops. So that was the adjusting entry. So that was what they did August the 31st, and now September 1st, you would debit service fee earned of $6,000 and then credit the accounts receivable. And then previously what they did is they had insurance expense debit of $3,700, prepaid insurance credit of $3,700. So then for this, you wouldn't reverse it because this is already correct. So let me explain. So the first one, A, the company has earned $6,000 in service fees that have not yet been recorded. So we haven't recorded it, so we have to go ahead and do that over here for the reversing entries in order to recognize that they actually, because they earned the fees, they just haven't recorded it. And then of course they're also owed the revenue for that because they haven't, which is the accounts receivable, because they wait either to record it either at the period end or they wait to record it once they receive the cash payment. The company had earned for the unearned service fees. So unearned service fees of $2,900, that's a debit, credit to service fees earned. And so again, for this, it's already correct. You don't have to reverse it. And then you have depreciation expense of $3,300 and then accumulated depreciation of $3,300. Same thing, this you wouldn't reverse. And then employees have earned but not yet been paid salary. So you have salary expense of $3,400 and then you have salaries payable credit of $3,400. And so then what you'd have to do is salaries payable $3,400, salaries expense $3,400. So what they did here is they closed out the books here. So they wanted to close out that for that period. Over here, they still owe that to their employees. They haven't yet paid them yet. And so because of that, then you will debit salaries payable and then credit the expense then. Because we're going to pay them then when we do the next paycheck.